to run through some slides to tell you what we think has gone on and is going on. That's the disclaimer, which, as you know, we are required to show by our regulator, and you should read. I'll pause for a moment in case you wish to do so. I always paraphrase it and say, if you believe what I'm saying, it's your problem, basically, is roughly what I think that says. I think it's always quite a good start with these things to, as you know, if you've attended these before or any of my meetings before, to at least touch upon what we think the proposition is that caused us to do this in the first place. And why did we set up the Fundsmith Emerging Equities Trust? Well, it was because we experienced a growing demand, inquiry from our investors for direct exposure to emerging markets. They seemed to like what we were doing in our main equity fund and said, do you like exposure to emerging markets? And frankly, that's not a question you can answer quite simply, but forced to give a yes or no answer, yes. Then why don't you hold any of the emerging markets companies, ones that are headquartered, listed and operating emerging markets companies, that do what you like in your main fund? And that's really why we set this up. We do like that exposure to emerging markets. We particularly like the exposure to one of the secular growth trends in the world. By secular, I don't mean non-religious. I mean something which is actually not cyclical. I don't mean growth where, as you find in many companies, the sales demand goes up for a period when the economy is going up and then goes down when it's going down. We like things that go up and just keep going up, preferably secular growth. And one of the most predictable ones in the world since roughly the end of World War II or shortly thereafter, from about the 1950s, has been the growth in the consumer in emerging markets, in developing economies. People, as they pass a certain threshold of disposable income, become consumers. They have to become consumers. It's not just that they want to become consumers. I mean, many of them do want to become consumers. But actually, the reason why they're becoming more prosperous, why they're getting this disposable income rise, is they're working in a country which is industrializing. So they've got jobs for the first time in a formal sense outside the agricultural sector, in industry or in call centres or in offices, and they need to actually have the convenience of consuming in the same way that we do with prepared foods and processed foods and so on and so forth. So, yeah, we did like that exposure. We didn't think we should do it through the main fund, and the reason for that is the lower liquidity that you've got in emerging markets stocks versus the ones that we've got in the main fund. On average, very, very roughly speaking, the liquidity in our in the stocks that we invest in the Fundsmith Emerging Markets Trust is about a 40th of what it is in the main fund. And the main fund is an open-ended daily dealing fund. If any of you are investors in the main fund and you want your money back, if you tell us or the call centre or whoever your agent is before lunchtime that day, you will be out of the fund that day. And we're quite capable of handling that because the companies we invest in are very big and liquid. The average market capitalisation or value of those companies is about £78 billion. So we can quite easily liquidate the money if you all put your hand up at once and ask for it back. We can manage that. You can't combine that, or you shouldn't combine that open-ended daily dealing structure with securities that have got limited liquidity. People do it from time to time in the investment industry, usually with some disastrous or tragic consequences a bit later on. We saw it after the Brexit vote last year, where all of the open-ended funds that invest in UK property were gated and couldn't give investors their money back because you can't actually go out and sell the shopping centre the next day because people ask for a redemption. So that's why we launched the Fundsmith Emerging Equities Trust, was to capture directly this growth in the consumer and emerging markets in what we think is a safe vehicle to do it, given the liquidity constraints of the sort of companies involved. And we showed this chart at the time, and there are lots of these charts that you can get. This looks at the growth in the consuming class worldwide, which is basically the light blue on that, and you can see the numbers from 1950 through to 2010 over there on the left, with the growth in consumers, and you can see predicted out to 2025 from this particular report, and there are plenty of reports like this, that the consuming class actually will be the majority of the world population by 2025 if this forecast obviously comes to fruition. And notwithstanding the fact that emerging markets have had a fairly tough time since the end of the commodity cycle in the last few years, and these blips do occur, they've occurred back in history when that growth was occurring, that prediction is roughly going to prove to be right. We are in the middle of that period and it is on course to happen. And if you look to the right, we've just blown up those two things at the end and we've given them actual numbers. If you look at the growth in there, the developed world will go up from 26 to $34 trillion in consumption. So 8 trillion of the additional consumption that's predicted will come from the developing world, where we mostly all live and work, and $18 trillion of it will come from the emerging markets. If you are interested in consumer stocks, and we think that consumer stocks are the best in the world in producing a risk-adjusted return because of their predictability, then the place to look in terms of where you capture the majority of the growth is clearly not the developed world. We are not making very many new consumers. The birth rate is quite low, and we're not making much new consumption. The prosperity of the people within our communities is not rising that much in real terms. And there are plenty of these around. This is one that we didn't show at the time of launch because it wasn't around then. This is a Euromonitor Bain one, and it shows the percentage of increased consumption and where it's coming from. And basically, if you look at that chart, you can see that China, which is the sort of deep red at the bottom, India, which is a sort of orange colour, and other Asia, which is a sort of beige colour above, is predicted to be somewhere around 60% of the increase in consumption by the time you get to the middle of this century. And you can see even back where we are now, it's a third of it, basically. Not much of the consumption is, increase in consumption is coming from the developed world, and that's going to be a trend that's going to increase over time, is what they're telling us. Now, in order to capitalise upon that, we need an investment methodology. And the investment methodology we've got for this fund is exactly the same as the one that we've got for our existing fund. And a slightly different way of explaining it, which I've adopted this time. If you know the main fund, we say, try and find good companies and only invest in good companies. Try not to overpay for them, then do nothing. I thought I'd give a slightly different method of explanation today. It is exactly the same strategy, but just to walk through it, partly just to stop extreme boredom setting in if I keep repeating the same thing, trying to show you how we do this. I would put forward the proposition that in order to develop superior investment returns over time, you need to find companies with a high return on equity capital employed. So their capital that they've got in the balance sheet as the denominator in a calculation with some numerator, preferably their cash flow, but some form of profit, if you don't like cash flows, which you could use, must be a high number. I don't think this is a matter of opinion. Other people who've achieved a great deal more than I'm ever going to achieve in investment will tell you this is the primary thing to look at. And the thing I always quote is Warren Buffett's letter to his shareholders from 1979, where he states that very clearly. Since he stated that, of course, it's been almost universally ignored by people, as is the want of the investment industry. But it clearly is. You don't need to be able to understand corporate finance in order to understand this. Companies are just like us. Basically, if you borrow money from your bank at, let's call it 5%, and you invest it with us and we make you 10% per annum, you're going to become wealthier over time. If you borrow from your bank at 5% and we make you 2.5% per annum, you're going to become poorer over time. That's a company with its cost of capital, you're borrowing from the bank in this particular case, and its return on capital is the return that you're getting. It's pretty simple stuff, really. It's a very simple subject made complicated by people on occasions. Unfortunately, it's not just as simple as finding companies with high returns on capital, though. You also need them to have a source of growth so that they can take some of that return each year and invest it in growing the business. That's where the real compounding comes from, basically. Equities perform a function that no other class of investment asset can perform. I wrote an article about this for the Financial Times a few weeks ago in the FT Money section, which we can provide you with copies of if any of you'd like to read it. One of the things that companies do is each year they produce their cash flow or their earnings, depending on which way you want to look at it, but whichever, they invest a portion of that cash flow or earnings into the business, their retained earnings, in order to grow the business and maintain the business, actually, as well. That is something that no other asset class does. If you owned this building, so if you owned real estate, you would get a rent check every year if you had a tenant. You just get cash. It's not automatically reinvested in real estate for you. And even if you go and take the check and invest it in real estate yourself, there's no guarantee you can get the same rental yield when you reinvest it as you got when you originally built the building. So you have reinvestment risk. Ditto with bonds. Bonds pay an interest coupon, but you just get the cash. You don't get any more bonds. The money isn't reinvested for you in bonds. There is one minor exception to that. In highly leveraged situations, so management buyouts, leveraged buyouts and so on, you sometimes receive bonds as an investor called PIKs, pay in kinds. And they will pay more bonds when they're unable to pay cash. So the only time you actually get any more bonds is the moment when you really, really don't want any. The way of life. Equities take a portion of their earnings and reinvest them. And when companies are able to do that, and they're able to do that within a powerful business franchise, they can generate returns on that reinvested capital that we can never hope to get through by buying shares in the stock market. So if the companies are making a 25% return on capital employed, the portion of capital they reinvest, if they can maintain that return, will get you 25% return, basically. We, on the whole, can't get that in the stock market. They're able to beat what we can do in the stock market because they're investing within a powerful business franchise, basically. And so that growth is important. They actually have to sell more products and services in order to find something to invest in. There has to be a source of that growth. So we're looking for companies with high returns and with the ability to invest some, or even better, all of the cash flow they generate at similar returns in the future as they grow. And then lastly, but definitely least, we're looking to buy this on a cheap or at least reasonable valuation. Throughout my career, I've had endless conversations, which I wish I'd noted now, with people about investments in the forms of stocks or bonds or funds. And I would really like to have kept a calculation of how often I was asked about the last question, whether something was cheap or expensive, compared to when I was asked about whether it was a really good business to invest in. Because I would say it's entirely the wrong way around. Most people spend their entire time asking whether something's cheap or expensive. They really should be asking whether it's a good thing to invest in. That's the thing, because if you are a long-term investor, that return on capital and the ability to reinvest is the thing that will determine your outcome, not whether something is cheap or expensive. That's not an opinion of mine. It's a fact. It's a mathematical fact. There's a man called Charlie Munger who works for Warren Buffett who's got a wonderful quote that's worth looking up on it, in which he puts that fact before you. It's exemplified by a much pithier quote from Warren Buffett, who said, "It's better to invest in a wonderful company at a fair price than a fair company at a wonderful price." And he's not giving you an opinion, he's telling you an investment fact. So that's what I think is the basis of trying to generate superior returns. So what are we doing in the fund with regard to this? Let's just go through them one at a time. Investing companies with a high rate of return. Well, there's a slide which looks at various multinationals, which are companies that we either own or would consider owning in our main fund, so people involved in the consumer staples business. And it looks at their quoted emerging market subsidiaries, some of which we own in the FEET fund. And what it's showing you is their return on capital employed. In the case of these, in each case, the red bar is the emerging market subsidiary, which we can or do invest in, and the lighter red or pink bar is the multinational parent. And as you can see in every case, the return on capital employed, in bar one, the return on capital employed is markedly higher in the emerging market subsidiary than it is in the parent company. The only exception on there, you'll see there is Kimberly-Clark Mexico, which is there, which we do own in the fund. And the reason why in this particular case the parent company there is a bit higher than the Mexican subsidiary there is the Mexican subsidiary currently has a very high level of cash, net cash on the balance sheet. If you take that cash, which is not needed at the moment for the business out, it would take the return on capital employed to about 48%, so it would take it out to about there. These are higher return businesses than their parent companies. Basically, if you're not familiar with all of them, East African Breweries, for example, is because they haven't always got the parent name in them, is a Diageo subsidiary. HM Semperna is the Indonesian subsidiary of Philip Morris. And we see that within sectors as well, very clearly. If you look at the brewing sector, what we've put on here is the major multinational brewers at the bottom here. So AB InBev, the biggest of all, Heineken, SABMiller, which is now part of AB InBev, Kirin in Japan, and Carlsberg. There's their returns on capital employed. And then at the top of the chart, those are the returns on capital employed of the quoted subsidiaries of those companies in emerging markets. Now, it's not that we only invest in quoted subsidiaries in emerging markets. It's just the easiest way, these slides, of giving you a fairly direct comparison about the returns that are available. As you can see, in all cases, the returns are bigger in emerging markets. And there's a clear reason for that. Beer is a product for which there is great local loyalty. Basically, in every country in the world, the biggest selling beer is a local beer, without exception. But from the biggest country, China, in population, to the smallest, Caribbean islands, it's a local beer. And there are reasons for that. There are social reasons why people are basically fond of their local beers, and there are actual physical reasons and economic reasons. Beer is a bulky, perishable commodity that's often transported in glass. It's not something which is greatly susceptible to export. It's mainly made, notwithstanding having export as a name in a number of cases, it's actually locally produced. And so that's why people who are in markets which have got much better growth characteristics are able to produce wonderful returns on capital employed. You can see the return on capital employed, which, as I said earlier, I think is the single most important measure of company performance in our fund, was 54% last year. The Morgan Stanley Capital International, MSCI, Emerging Markets and Frontier Markets Index, with which we compare ourselves as a benchmark, was 14. So we are basically, as you can see there, somewhere in the region of about 4 times the return on capital employed there. Our main fund is 27%. That's not a particularly shabby performance, that's pretty good, but you can see we're generating within these companies about twice the return on capital employed. The gross margin, the difference between their cost of their sales and the input costs of the goods that they sell, is 48%. On the index it was 31%. In the main fund, it's 62%. We are lower than the main fund for a very simple reason. In this fund, we will buy retailers who always have somewhat lower margins, whereas we don't buy them in the main fund. We don't buy them in the main fund because almost in every case, international retail is a disaster. Retail, mostly in the world, is a local, regional at best business. Operating margins, 19% on the fund, 17% on the index, 25% on the main fund. Again, we're lower than the main fund because of retail. I also would suggest that this number here is not a truly comparable number. Bloomberg, who produced these numbers, include other income in there, rather than just their operating profit. So when someone sells a business and they get some other income from it, it gets dropped into that line there. So I think it slightly overstates that. This is free cash flow conversion, this rather ugly acronym here. It works out the amount of their profit which is delivered in cash. Not all profits arrive in cash. Profits are quite often absorbed by working capital. You sell something, but if you give credit, then you don't get paid immediately. It becomes a payable in your balance sheet. You don't get cash always from profits immediately. Our companies last year generated 108% of profits in cash. They generated more cash than the profit. They were able to do that because they were actually paying people more slowly than they got paid, quite simply. The index was 91% and the main fund was 99%. I would suggest that with 1 or 2 explanatory things about why this is slightly lower than that, these are clearly a very good set of companies in terms of their performance. And you can look back, or we can provide to you if you let us know, that chart over the years, so that obviously you're looking at a snapshot here of a particular year. That's not a particularly exceptional year. It's not that we've just alighted upon this situation in the last year. This is how they have performed. So I think we've probably got a bunch of companies with a high return on capital employed. Do they have growth? This is a chart, rather like the one that you had earlier. I hope you're able to see at least some of it, where you can see that we've put 2 different growths on the axis. So on this axis, we've put the growth in revenues, in their sales revenues, and on this axis, we've put the growth in their free cash flow. So those are the percentages for those 2 things. These grey dots, which are scattered around here, are again the multinational subsidiaries, parents, and these red dots are their subsidiaries. And there's a clear pattern. You can see that if you were putting a line of best fit, it would run a bit like that. The higher growth in both revenues and in cash flows is coming out of the multinational, is coming out of the developing world emerging market subsidiaries. Things that we own within that, that we like and that produce that, you know that we like personal products. Procter & Gamble isn't a company that we own any longer in the main fund. We do own one of its Indian subsidiaries. And we also like some other companies locally which do exactly the same thing, which are not part of multinationals. So we don't only invest in multinationals. I only gave you that comparison so that you could feel you were looking at like for like. We invest in household product companies, people who make cleaning products and so on, like Unilever. We can invest in Hindustan Lever, which we do, Kimberly-Clark, Mexico, and Jyothi Labs, which is a maker in India of detergents and whitening products. We like food products, companies like Nestle. We can invest in Nestle Pakistan. Lala is the leading Mexican dairy company. Editor is the leading baking business in Egypt. We like drinks companies, Diageo. We own East African breweries. We can own these. That's their Indian subsidiary. We like franchise businesses. We own this company and this company, which are 2 South African-based fast food franchise businesses. So we're able to follow through into the same sorts of businesses, whether they're the multinational subsidiaries or not. It leads to us having brands in the portfolio that are providing these returns, some of which you've heard of. I should think you've probably heard of Guinness. The Guinness bottle we've got up there is a Guinness Nigeria bottle, which was introduced in 1827. These are not businesses that have only just arrived. The other ones up there are Maggi in India, which is the main Nestle product in India. Colgate in India, which you can see in the bottom left, which has got 57% of the Indian toothpaste market, which is a pretty impressive statistic. Rexona, which is a deodorant antiperspirant brand from Unilever, that's their Indonesian subsidiary brand, and Skol, which is the market leader in beer in Brazil, which is sold by Ambev and has got 33% of the Brazilian beer market. So they have powerful brands. Some of which you've heard of, if not in their particular guise from those markets, in your own market. Some of which you may not have heard of. So Parachute is the leading air oil brand in India, marketed by Marico, which we own. This is an over-the-counter formulation sold by a company that does drugs in Brazil called Hypermacas, which has done very well for us, which we own. This is Foshan Haitan's Golden Label soy sauce. It's the oldest selling soy sauce in China. And as I always say when people are talking about economic downturns and how it might impact us, if the Chinese stopped consuming soy sauce, things are really bad. We're unlikely to get there, in my view. I think we're pretty safe on that. Indomie Noodles is the brand of a company called Indofood, which we own in Indonesia. That brand is actually, if you look at the Kantar World Panel data on brands, it's the 8th largest fast-moving consumer goods brand in the world across all markets, basically. People underestimate the size of Indonesia, I think, when they're thinking about things like this sometimes. It's a widespread brand in a country with quite a large population. Goodnight is the leading brand of mosquito repellent and treatment in India, for a company that we own called Godrej. It's got 50% of the market in India. It's a pretty good market to have this win when you think that the main weather feature on which the rural economy of India relies is the monsoon. You can imagine that a mosquito repellent's a pretty useful product in those kind of circumstances. And All Gold is the leading brand of what they call tomato sauce and we would call ketchup in South Africa and Sub-Saharan Africa, owned by a company that we own called Tiger Brands. And as you can see, quite a lot of these have been around for quite long periods of time. So they'll probably make through into the future for us, I think, would be my guess, if you've got brands that have been around, in some cases, for centuries. The index composition for the MSCI is one that we don't follow very much in terms of our investment. That's the MSCI broken down by sector. The red sectors here are ones that we are prepared to own. And the bits that we are prepared to but have comparatively little are consumer discretionary, things like hotels and cosmetics and so on, and information technology where we can find it. We don't own any financials. We don't own any energy, any materials, any telecommunications services, any industrials, utilities or real estate, which are the other ones there. They're not things that we regard as investable, given what we're trying to pursue as a strategy, which we think will be something that will produce superior returns over time to these other bits that we don't own. We differ from the index in country weight significantly as well. The index over here, you can see China is by far the largest part of the index, largest single country in the index, closely followed by South Korea and Taiwan. India is a mere 8% of the index. We own very little in China. We are a bit pessimistic about the macro outlook in China, and we can't find very much in China which satisfies our quality criteria. We do own a few things, but not much, and we almost invariably own them through H-shares quoted in Hong Kong. We don't own anything in South Korea and Taiwan. We think actually including them in the index indicates something which is not very helpful. The index, in deciding whether something's in emerging markets, looks at the characteristics not of the country, but of the stock market in the country. That's how Taiwan and Korea qualify. They are, in fact, developed countries, quite clearly. They do not have the economic characteristics of an emerging market class that the countries we seek to invest in have. They're developed economies, basically. So we do not invest, haven't found anything to invest in them. If you look at what we do, it's quite clear that we're very enthusiastic about this. That 35.8% of our fund is in India, which is only 8% of the index. We think that the outlook for India in particular is a very positive one. We think Narendra Modi, the Prime Minister, and his reforming regime is on the verge of achieving some quite big breakthroughs in terms of what will happen in the Indian economy, which also has the major benefit, in current circumstances at least, of being a major energy importer, which in emerging markets is now a very big differentiator. This is a chart, a table produced by this gentleman, who's a professor at the Stern Business School in New York, who does a lot of good stuff. A lot of his stuff is worth reading if you can get it online. He looks at sectors. This is, again, only a snapshot for a year, but it's pretty typical. He looks at them on the basis I was trying to describe earlier, which he takes their return on capital, takes off an estimate of their cost of capital, and tells you whether they're making more than their cost of funds or less than their cost of funds. And as you can see, there's some pretty big negatives here, things that we won't own: oil and gas, precious metals, metals and mining, coal, steel, shipbuilding, oil field services, utilities. All of this stuff on the basis of these returns is uninvestable. Now, you might well say, well, they're cyclical and they'll come back. Yes, but from time to time, they will look like this, and we don't want things that from time to time will look like this. The things that we do own are things like over here, which starts at about here, where you can see beverages, 15% positive spread over their cost of funds, household products, 17%, healthcare support services, 23%, and tobacco, 32%. That's where we want to place our bets, and where we do place our bets. Fund performance. I think it's fair to say the fund performance has been, you can pick the right word, I think, in the end, because after all, it's you alongside us who are the investors, but frustrating would be the word I would probably pick out to describe it, insofar as we have significantly underperformed the index since inception. We've started to get closer to the index more recently. If we're right about this strategy, and by the way, we do invest with a very, I assure you, me and my colleagues, mostly at least, invest with a very, very strong sense of paranoia, I assure you, because there's always the possibility that you're wrong. If we are wrong about it, I wonder why it hasn't shown through so far. And I think the answer largely is in this. ETF fund flows. As you know, the exchange-traded funds, which many people mistake for the same thing as an index fund, but they're not, they have been the dominant recipient of flows from investors in recent times, in general, in the equity markets. That is even more pronounced in emerging markets. And what these two charts show, and I hope that you can see at least some of it, is the period, that line there is when we opened for business with our trust. They show you the funds flow into emerging markets, which has gone into ETFs, which is the faint line, which you may have a little difficulty with there, and active funds, funds like our fund, there. You can see that, because this one is below zero, that line there is zero, more than 100% of the funds which have gone into emerging markets since we've been open, significantly more than 100% of the money has gone into ETFs. They've not just been a recipient of the flows into emerging markets, they've been a recipient of the flows out of the other active funds out there. The open-ended active funds have lost funds to the ETFs. And you can see this is the is 2016, which we've just taken from here. You can see, and rebased to zero. You can see here the clear divergence between those two things. Now, this is having quite a big impact, because there are the two tables showing the top 10 stocks in the emerging markets there. So you can see what the stocks are there, and the sectors which dominate the emerging markets index there. And you can see that the index is dominated by financials, information technology, in which we've only found one business, consumer discretionary, yep, we don't mind some of that, energy, no interest, materials, no interest, and so on. So the big bits here are things that we will not own. And these companies, the top 10 which are here, are all companies that we would not own. Samsung Electronics, consumer electronics. Tencent holding Chinese online services which you can't legally own as an outside shareholder. It's impossible for you to do so. You have a piece of paper that says someone promises you own something like it. Taiwan Semiconductor, so someone who makes semiconductors. Alibaba, another Chinese e-commerce. China Mobile, China Construction Bank. Naspers, a South African media and technology business which has got an investment in one of the other companies on there. And you can see it's the sort of thing Taiwanese consumer electronics, none of them fall into the sort of thing that which we will own. You can see that more clearly on this. This is our top 10 holdings and the top 10 in the index. You can see there are the companies that I was just talking about in the index. Those top 10 comprise 20% of the index. There's our top 10, which are 33% of our fund. As you can see, none of those names are over there. We do not own any of the companies which dominate the index. Now, rightly or wrongly, I think that's exactly the right way to manage money, is not to actually, if you're going to manage money actively, you need to diverge from the index, following that good old axiom of Sir John Templeton: if you want a different result, you need to do something different. And we are doing something different. Just to say, as a subset of our companies, these top 10 have a 44% return on capital employed at the moment. The index companies, these top 10, have 12. All right? with the South African company coming in with a negative. I am, notwithstanding what the fund flows have done to our relative performance, quite happy to own those versus those. Okay. You can see this in a particular company here. Here's the South African technology and media company, Naspers. You can see that's an estimate of its cost of capital over the last 10 years, and these are its actual returns, which, as you can see, are mostly below its cost of capital and on a fairly clear trend. This is one of our Indian consumer goods companies, Emami, and you can see, notwithstanding some ups and downs, there's its cost of capital, there's its returns over the period. In terms of what we're looking for, we've definitely got the right kind of thing. Lastly on this is the Samsung share price. What we've put on here is simply the last year's share price for Samsung, which you can see is on a clear upward trend. I think it's up 69% in the last 12 months. And if you read these labels up here, which are the bits you won't be able to read, you will find that they are the events of the last 12 months, which include things like their biggest new product being declared illegal on aircraft, even when it was switched off, and the management being arrested and charged with fraud. And not the usual kind of thing that leads to you going up 69%, unless, of course, you're the biggest share in the index when the money going into ETFs is going into things like that. And it's frustrating. People often, fund managers, of whom I'm one, often sit and wring their hands and complain about the rise of passive investing, index investing, ETFs and so on. And I can understand why they do that, but we shouldn't do that, actually, because providing our strategy is right, and you'll make your own mind up about that in the end, and providing we have the patience, and we both need to make our mind up about that, then actually what we really want to be is the last active investor left, because we will be the final investor who, all of the other investors who've gone passive will be investing on a basis where they can make no decision whatsoever about the quality of business that they invest in or the valuation on which they invest. We will be competing with people who are not thinking. Their entire basis of their product is not to think. Last but not least, but not the most important factor, what about valuation? So we've got these probably good companies. I might have persuaded some of you of that. They've got good returns and they're growing faster than their comparable companies in the developed world. They're probably better than the things in the index, which are causing quite a big distortion at the moment. What about valuation? This is a slide which shows valuation on the basis of the free cash flow yield. I'm sorry, it's a rather long acronym. For the last 12 months for our companies, that's 3.5%. The index is 5.8% and the main fund is 4.4%. Yes, our companies are on a lower free cash flow yield, that's the free cash flow divided by the market value, than the index. They're more expensive. And I had a debate with an institution I saw yesterday. I had an online debate with them overnight about exactly that point, where they said, well, I mean, one of the things to say is that the other things that are in the index are undervalued. And I said, well, I think you're using the language very sloppily. They're more lowly valued. Right? They're definitely more lowly valued. They should be more lowly valued when you think about it. Let's look at their other differential characteristics basically out here. This is the growth in the comparable measure, that the free cash flow. Our companies last year grew their free cash flows at twice the rate of these companies, and they're able to invest at about 4 times the rate of return of these companies. Now, that number there is about 60% difference. So it's about a 1/3 difference between those two, as it is if you look at the PE as well. We're talking about a PE of 24 in our portfolio versus about 16 on the index. So that's about the differential. The differential in these numbers, the growth rate and the return, is much higher. I would suggest to you that you can't look at, well, you can look at things simply like this, but it will be a mistake in the end. It's not whether our companies are more highly valued, it's whether or not the degree of valuation is sufficient to compensate for the quality that we're getting. I think we're getting far more quality than we're paying for. If all you do in life is go and buy the most lowly valued shares, you are automatically going to end up with a very low quality portfolio. If you're going to buy things which have got high quality, you are going to have to accept that unless markets are totally imperfect, you are going to have to pay a bit more from time to time. How have we done on turnover? We had quite a high turnover last year. Number of things, including the instance I was talking earlier about companies which were taken over by multinational parents, caused a portion of that. If you broke that down into the 2 halves of the year over, you would see that the second half turnover was quite a lot lower, and I think you'll find when you get the first half of this year out of the way, obviously at the moment we're most of the way through it, not all the way through it, you will see that the turnover is now beginning to go back to where we would ideally like it to be, because turnover costs money, and it's not something that we particularly like to engage in. We've been issuing some shares when we've been at a premium in relation to investor demand. People have come through a number of wealth managers and our broker And so we've been issuing shares. I think the number is actually £46 million that we've raised now since inception. It's all been raised at a premium, an average premium of 1.8%. For us as existing shareholders, that's a good thing, because obviously other people are buying our assets at a premium to their NAV. Providing you trust us, this is a qualification that the new money we're raising is not being invested on a worse basis than the existing money that's in there, that we're not doing something to destroy value for you with the new money that we're getting. I assure you we're trying not to do that. We're doing our very best. And that's something I think which we will continue. We continue to think we can identify these high quality situations, which we think in due course are going to produce a superior investment return because of the methodology of looking at their returns versus their growth compared to the rest of the world. So I think we will continue to do that if the opportunity arises. And that's all I actually prepared to say, but I'm happy to try and address anything else, or even better get my colleagues to address anything else if you want to know anything else.
Terry, free cash flow yield growth. You quoted a figure on a couple of charts ago of 11% for the main fund.
11% the main fund, yeah.
The term for, well, you quoted the sort of the line across, 16%, but you referred to NFCFE, which sounds different.
It's not really different. It's actually the same thing that we use on the main fund, but for some reason we decided to put the full acronym up on these. It's neutral free cash flow. What we mean by that is assuming in that calculation, I'm sorry, this is going to be horribly technical, but it's trying to answer your question. We assume in the calculation of free cash flow on both funds that the depreciation is giving us a yardstick for maintenance capex. So when we calculate the free cash flow, it's basically before the payment of the dividend, fairly obviously, but we also add back into the cash flow any capital expenditure which appears to be for growing the business. Otherwise, it would always be zero on a business that could spend all of its free cash flow on growing, and we'd never buy it. And so that's the calculation we make. We make it on both of the funds, but we didn't actually bother to put 5-letter acronyms into the main fund. I wish we hadn't bothered on this one as well. Not because you pick it up, but purely because I find it a bit of an annoying acronym. I find 3-letter acronyms annoying enough.
Okay, question.
It's Peter Norman. How far, if at all, are you influenced by political developments in the countries in which you invest? I'm thinking particularly at the moment of Brazil and
yes.
also South Africa, where the ANC is obviously in difficulties.
Yeah, indeed. Not a lot is the answer, because they're difficult to predict. We're not political scientists and predictors. And in any event, one of the mantras which I keep to, up to a point at least, is the worse the country, the better the company. Quite a lot of companies are able to prosper within environments which are quite difficult. So at the moment, the companies which we own, for example, in Brazil, I would suggest to you have done pretty well for us, particularly in the case of Hypermercas, which we've held for since inception, notwithstanding the problems of 11 quarters of economic downturn, which is a record now in Brazil, and the obvious political turmoil that you're referring to. It's not always the case that we take that view, but we try to take that view where we possibly can. That actually trying to predict politics is So if I were going to take a position on our South African companies, not on the basis of whether I like them, but on whether Jacob Zuma is going to survive the next vote, it would be something that I don't feel terribly qualified to do. And in any event, I think what we own is not bulletproof in terms of political development, but it has shown the ability to prosper through a pretty difficult circumstance.
Yeah, I'm struggling with the premium over your net asset value. Traditionally, when I invest in investment trust companies, a premium indicates considerable investment in that fund. And yet, in a part of your delivery, you talked about ETFs attracting all the funds. So are you, by implication, suggesting that the net asset value premium is really a reflection of the performance perceived from your other fund?
I'm not particularly suggesting it's anything, because obviously in the end it's not something that we do anything to determine. We could do, in fact, you might say everything we've done so far in dealing with the situation of having a premium has been to eradicate it, because we've issued more stock. So look, I'm not required to, and don't particularly want to either, reach any great conclusion about the persistent premium that we've had. But I think the most important thing about the sort of premium or discount that a trust might attract is for the board to behave logically in relation to it, which obviously in the case of a premium with regard to existing shareholders means that if there's demand, issue and an investment opportunity, which they question me about regularly, then raise more money, and if there's a discount, then buy the share that you know best, which looks cheap, which is presumably your own. If for one moment you were attracted to this as a strategy, and hopefully you are since you're here, and I'm not just mean you, I mean actually up to and including an institutional level. We have some corporate pension funds that are invested with us as well. You can't just go out and buy the shares. I tested, just because I think you should test these things regularly, to try and do it myself with a Sri Lankan share. And I couldn't find, and I'm pretty well versed in the industry. I've worked in the broking industry for a couple of decades. I couldn't find anyone who was able to execute a bargain for me in them. So it isn't easy to access this without having quite a lot of infrastructure that we've set up, including legal and regulatory infrastructure. And then you might say, well, there are lots of people who've got that legal and regulatory. I could go and buy myself some Aberdeen or some Templeton. Yes, you could, but I think you'll find you've got the index then, because they're big and they mainly buy it. So if you want this particular type of strategy and you're in that area, it's very difficult to DIY. That might be, I think Martin's right, that might be part of the reason for it.
Another question over here.
Thank you, Chairman. My name is Robert Barker. I'm not on the share register. Given what's just been said, and given the resolutions that allow you to raise another 25% of capital of this company, would you be able to invest that additional 25% over the next 12 months, if it came to you, in similar quality of companies?
Yeah, I'm asked it at every meeting, and I went through in this meeting, as I normally do, because it's overall to go, yes, actually specifically what would I do? And we went through that, and I'm happy that I can deploy that kind of amount on what we can see before us at the moment, and hopefully they're happy too. So if they are, then we'll continue. But yeah, we go through it, and we go through it very specifically in terms of not just yes or no, but okay, tell me what you do with it. And so I do tell them what I would do with it. So yes.
You never talk about installed bases of equipment in the sense of lifts and escalators, which you've talked about in the main fund.
Yeah.
Is it that the emerging markets have missed the boat, so basically just the main big global companies are in there? Because clearly if the middle classes are growing, then there's going to be more shopping centres and shopping malls and things like that. Are there any installed base of equipment companies in the emerging markets that we could invest in?
I haven't found any so far, sadly. Most of the people who are operating on that are either, as you touched upon already, the multinationals. So the biggest elevator company in China is Kone. And where it is a service business rather than manufacturing business, they're mainly locally privately owned. So we haven't actually found anything. Some of the things that we like in the main fund are pretty difficult to find. That's one of them. There are others as well. Finding IT businesses of the sort that we've got in the main fund is difficult. Finding healthcare is quite difficult. We're finding it, but not yet on the scale that we would like to find it. We've got one IT company now in the fund, and we've got two healthcare companies in the fund. But there just isn't the sort of breadth of those companies in the emerging markets that we're looking at that we've found in the main fund.
Okay, my question regards, in an annual report you mentioned you tried to exit a couple of companies in Nigeria.
Indeed.
You sold them, but then you found you couldn't remit the money back, so then you had to rebuy them.
Yes.
So in that context, we've also exited Turkey last year.
Mm-hmm.
So it seems that these are points of maximum pessimism. You're exiting these countries at times when there's a lot of fear around the market. And so wouldn't you think that this would be the time to be greedy when others are fearful? Thank you.
Yeah, I mean, there's a lot of ways of attempting to answer that question. The main one is to say perhaps I was wrong, because usually when I try and do anything on a macro basis, it sort of comes back to this gentleman's question earlier in many respects. It's difficult to predict, and I'm not very good at predicting it. I mean, they are a bit different, the two of them. In the Nigerian case, we did foresee the Naira devaluation, and we thought, well, we've got we've got 4 holdings in Nigeria, and it was reasonably sized compared to the index. How about we sell the 2 weaker holdings, take the money out, and so on. It illustrates the problems of doing this, that actually, yes, we did that and then didn't manage to get the money out. Quite right. And look, being in an economy which is going through a bad period, is bad enough in terms of investment. So not being in equities at that point and being in cash is a really bad idea. So we reinvested immediately. Turkey, we didn't sell for that reason, actually. I mean, for all of the turmoil that you see around Turkey, the one thing I would guess is that the Erdogan regime is quite pro-business. It may not be pro-democracy, I suspect, but it is quite pro-business. And it's none of our business whether they're pro-democracy. That's not what we're here for. We actually sold our hard discount retailer BIM there because we think they're beginning to cannibalise their own business a bit. And that's the reason why we exited BIM, not anything that particularly pertained to the macro situation. Because on the whole, I think that whenever we get near to making judgments on the macro, we run into exactly the problem that you identify.
Terry, currency exposure.
Yes.
On the main fund, I've heard you say that it falls sort of as it falls. In this fund, though, where, for example, you have a very large exposure in India, I noted, how do you regard currency exposure? So a fairly open question.
Pretty much the same way as we do in the main fund. Apart from the difficulty of making predictions in this area, and I've sort of tried it with myself over time in these currencies to see whether I'm any better at them than I am at any other currencies. Trust me, I'm not. The problem becomes one of, well, if you really like India, and I do really like India, I think there's a lot of positive potential there that will now, I think, be unleashed once we've been through the latest reform in the goods and services tax and the disruption from that settles. Finding a way of hedging these things and in addition cost effectively is somewhere between difficult and impossible. Obviously a number of the currencies, I hope it's obvious, a number of the currencies are not convertible currencies. They're not freely traded currencies, and in those cases you can't actually do a forward contract, literally. You have to engage in a thing called a non-deliverable forward. So we're back to acronyms, NDFs as they're known, which coincidentally, Talit Prebon, which I ran, was the largest broker in the world of NDFs. So it was an area that I knew something about, and there is very, very short and limited liquidity in those things, unsurprisingly. And actually the way it's settled is like a contract for differences. You get a cash settlement at the end of the contract either way. And really what it amounts to is in the sort of currency where you're discussing this, if you could get 6 months liquidity forward, it would be remarkable. 3 months might be more typical. The cost would be great as well. I mean, the market's quite good at extracting a fair price, at least from you, in terms of that hedging. And of course, bearing in mind the relatively short duration you can get, it doesn't solve any structural problems. In the end, you and the companies have to deal with something that goes beyond that duration. And even if you're absolutely precisely right about being able to predict an event, if the instrument you've got falls short in time scale, it doesn't help. If you manage to hedge the Naira 3 months ahead and the devaluation occurs 4 months ahead, it hasn't helped. All you've done is spent money on the hedge, basically. So, and we've had currency weakness across a pretty wide range as well. You know, we've been hit by Russian ruble, Turkish lira, Brazilian real, etc., etc. So we've had quite a big headwind. Now, I'm not predicting where that's going to go next, but it wouldn't shock me if at some point it reverses. And therefore, instead of worrying about India, we should actually be rather pleased that we're invested in an Indian rupee basis.
You've named a couple of events, the rise of exchange-traded funds and also the difficulty in finding places where you could actually make a bargain in a share. What do you see as events or trends that are going to help share prices in those companies rise over time to a greater extent than they are? I
think the main thing is a bit, I answered a question which was not the one you've asked, but somewhat different, but I answer it in the same way. The broker Killick have a magazine called Confidant. And I did an interview for them in January, and they were talking about the rotation that occurred in the second half of last year into cyclical stocks, financials and cyclicals, which was very topical for us because we don't own any of them. And of course, like everything in the world now, this has to have a label, so it became Trumpflation, if you recall. And they said to me, what do you think the biggest risk is to people who've put on that trade and adopted it? And I said, a collision with reality. You know, it's all very well to talk about concepts and look up self-surveys. Is there any actual pickup in economic activity? And if there is, we can't spot it. We cannot see any hard data coming out of companies, which is what we follow, around the world telling us that things are picking up. And I think the thing that will help with these companies is the reality of them producing results. Basically, it's as simple as that. And I think the largest portion of our portfolio, I'm sorry to keep alluding to it, but it is more than a third of our portfolio, is India. We've had a real couple of reforms in India where the Prime Minister has done things which are difficult and not popular. Demonetising the two denomination banknotes, which are 85% of the cash in circulation for a country where 85% plus of the people have no access to bank accounts, is something. Enduring popularity through that is tricky. The man's a great communicator, and I think he's taking people along with him in terms of where it takes them on the journey. He's just won the biggest state, or his party won the biggest state local election there, which suggests that he has got a basis for that. He's now about to, for the very first time, have the very first unitary goods and service tax in India. It's about to become a unified economy for the very first time in that respect. That's majorly beneficial. That will start to show through in results in due course, where I think consumer confidence will increase, the tax base will increase, the tax take will get fairer. People will be driven more towards digital payments and the modern retail economy, where cash is not the stock in trade. And I think the sort of results that you get from things like that in the end weigh on markets in terms of what companies produce.